Ajay Argal, Head of Indian Equities at Baring Asset Management, joins us live from Hong Kong. Ajay, morning. Always good to have you back on ET Now. Ajay, first, what do you make of the global environment? Suddenly it's a problem of plenty. In Europe, the problem has migrated from Greece to Spain. US economic data of late has been slow. And China, for the first time this year, has admitted that they are also feeling growth jitters.
Yeah, definitely the global backdrop has become more circumspect. So as you mentioned, there are concerns in each of the areas. And that is why the investors have become cautious. The valuation levels are very attractive, but because of the macro concerns and especially the sovereign debt concerns, whether it is from Greece or Spain, is keeping the investors very cautious. So that's why you see that people want to be on the sidelines and they are not willing to take very aggressive positions in the market.
But Ajay, do you see an immediate resolution of the Greek and Spain situation? Or do you think it is going to be a long-run process?
The markets definitely want some concrete action on that front. Whether that happens or not remains to be seen. So definitely we are approaching the Greece elections once again. So that is the uncertainty which the market is not liking. What market wants is basically the focus from the political leaders, especially in Europe, back on growth rather than austerity. And as long as the focus remains on austerity and expenditure cutting, the investors are wary that that would bring down the growth rates even further and maybe tip the entire global economies into recession. And if that be the case, then there is no hurry to get back into equities. So that's why a concrete action and some support on the growth parameters, be it in Europe and also to some extent in China.
Ajay, if I look at liquidity, because that really is the prime driver for any market in the near term, Indian markets are completely reliant on global liquidity. Now the good news here is that so far this year foreign institutional investors have not been sellers. In fact, they have pumped in about $8 billion. But the bad news here is that even though foreign institutional investors are not sellers, the Nifty is down to 4,900. So my question is that what if they start selling?
No, that's true, but the question is where do you have this kind of growth? Admittedly, India's growth itself has come down quite significantly, but still we are growing anywhere between 6.5% to 7%, and in the global scenario that is a decent amount of growth. The reason the Indian markets have come down is, apart from the slowdown in India, you have seen the pressure on the currency, and the pressure on the currency, I'm sure your channel has highlighted that. The reasons are well known, that our fiscal deficit is slightly on the higher side, and which is what the investors in the forex markets are not liking. And that's why there had been pressure on the currency. And the currency pressure is also partially because of the risk aversion mode, especially coming out of Europe. And if there is a resolution in Europe, or if there is some concrete action which normalizes the situation in Europe, that would be very good for the Indian currency market or Indian rupee. And once the Indian rupee stabilizes, that should be a good support for the Indian equity markets as well. So it is a complex situation. The Indian equity markets are not reacting on a standalone basis. There is repercussions coming from the currency markets.
But Ajay, what about the valuations? At 16,000 Sensex currently, are valuations looking attractive, or do you think India is still expensive relative to the other Asian peers?
See, it depends on how you look at it. India is expensive in relation to the in relation to the regional peers, but it has always been expensive, so it is nothing new in that sense. The reason it is expensive is the growth rates are higher and the return ratios are higher. Now the question is, our return ratios or return on equity has come down in the last 2 or 3 years. The big question is whether this ROE coming down is structural or cyclical. And if it is cyclical, then there is a case that even these valuations are attractive. Of course, you need to have a normal situation, and so that the global investors are willing to take some amount of risk. And the moment the global investors are willing to take some amount of risk, they will go to where the growth is higher. And India is one of the markets where the growth is higher. So from that perspective, and we still feel that the return ratios in India, the downturn which has happened is more cyclical rather than structural. And if the return ratios come back, then the Indian markets are attractive even at these levels.
So what are the sound bites you are picking up from some of your investors? Are you getting a sense that these levels, they want to revisit India? Are they giving you more money to manage?
The investors are definitely willing to look at India, but at the moment, investors are more focused on the macro events which is happening, especially in Europe, and also the perceived slowdown coming out of China. So the investors are more focused on the events in these geographies, and once they feel that things are normalizing there, then they would be looking to put money into India.
So what will change the market mood, Ajay, then? Will it be something at the policy front? Will it be global, or it has to come only from liquidity?
It can be either of the things which you mentioned. So definitely, if it happens from a local perspective, it is a better thing to have. So if you have some policy action, there has been expectations of a fuel price increase which will bridge the fiscal deficit. If that happens, that would be a big positive for the Indian local markets. If there is some stabilization of the situation in Europe and there is a focus back on growth there, and to that extent the focus on austerity comes down, and there is some resolution of the sovereign debt crisis, whether it is in Greece or in Spain, then that should be good for the risk takers or the investors willing to take some risk globally, and that should be good for the Indian markets.
At a time when Indian consumer stocks are outperforming and there is merit in investing in consumption as a theme, what's been your portfolio strategy? How are you playing consumption as a theme? Are you investing in banks which are proxy to growth? Are you investing in autos, or are you investing in FMCG?
We are actually investing in autos and banks. So in autos, we are positive because the price correction has happened, and to that extent the expectations have already been lowered, and we still see decent growth there at reasonable valuations. In banking sector, we were overweight, though we have recently cut our position to more neutralish, and that is more to do with the risk of happening globally. Structurally, we are positive on banks, again from the perspective that the expectations have already been lowered. A lot of bad quality assets have already been accounted for in terms of higher NPL ratios and higher restructurings. So in that sense, it is already there in the stock price. But it is just that as we are seeing this risk aversion, we have from a tactical perspective moved our position to neutral, and any sign of the risk appetite coming back, we would be looking to again get back our position to overweight in the banking sector. And we are not so positive on the consumer staples, primarily from a valuation perspective. The companies are doing reasonably well. There is no doubt on that. The growth has been there because the consumption is still doing very well in the overall economic perspective. But the valuations are pricing everything for perfection, and we think that there is very little room for disappointment. So we rather want to play the consumption theme to consumer discretionary and banks.
Ajay, are you working with the possibility that Indian markets could retest December lows?
We don't take a call on the amount of correction which can happen, but definitely we have turned a bit more cautious because of the recent events which have happened, especially coming out of Europe. So that's why, as I mentioned, we have reduced our position in the banking sector, though we are still neutral. And we are closely watching as far as the sentiments and the risk appetite is concerned. So that is anybody's guess, and I don't think we can predict how worse can the sentiment get and when is it likely to turn back.
So, Ajay, on a net basis, is it, or rather, is your portfolio tilt more towards the defensives? Are you still invested in consumption as well as FMCG names?
No, as I mentioned, our portfolio tilt is more positive, but it is just that we have reduced our positive bias, especially in the banking space. As I mentioned earlier, we are underweight on consumer staples, so in that sense we are not defensive. But looking at also the currency movement, we have increased our position in the software sector, where we were underweight and now we are mildly overweight there, because the companies are doing reasonably well and the valuations are somewhere in the middle. They are not very cheap, but they are not expensive either. And because of the concerns on currency, there is some support on the valuation side. So that's why we are overweight in the software sector. And we have always been overweight on the pharmaceutical sector, because in relation to consumer staples, we find that pharmaceutical is a better combination of reasonable valuations and pretty decent growth.
Final question, Ajay. So what is your big contra call for FY13, where you are leaning one side and others are leaning on the other side?
I think if you take a 12-month perspective, the contra call has to be in the industrial space. From a near-term perspective, it doesn't look very attractive at all, because nothing is happening. The order flows are not coming to any of the companies in the sector. But if you take a slightly longer-term view, and once things normalize both on global front, and there will be hopefully some action on the policy front in India, then the order flows should start coming back, and that should be good for the industrial sector. So one has to balance within the portfolio how much of the call one can take from a 12-month perspective, and if one is willing to take the risk, then I think industrials has to be the contra call.